If you have retired in the last 18 months, your name is already on a list. The list belongs to people you have never met, who do not yet know you, and who will, within the next 6 to 12 months, find a way to be introduced to you. I am going to tell you how that list is built and what is going to happen next. I am Richard Hall. I sat on the bench for 22 years in the United States, presiding over civil cases involving estates, fraud, and financial abuse. I want to tell you, briefly, why I am speaking publicly. There were 3 cases in my last year that pushed me to retire. In one of them, the lead plaintiff was a retired postman who had worked the same route in a small town for 34 years. He had been retired for 14 months at the time of recruitment. In another, the lead plaintiff was a retired neonatal nurse who had worked at a teaching hospital for 39 years. She had been retired for 9 months at the time of recruitment. In the third, the lead plaintiff was a retired professor of mathematics who had taught at a state university for 41 years. He had been retired for 16 months at the time of recruitment. The 3 cases involved different fund managers, different schemes, different jurisdictions for the offshore accounts. The plaintiffs lived in 3 different states. The schemes had no operational connection to each other. The fact that the lead plaintiffs in all 3 cases had been retired for between 9 and 16 months was, in any rational interpretation of the data, evidence that the recruitment timing was not coincidental. I read the petitions side by side. I made the decision that month to retire. I left the bench at the end of the term. I retired at 57, earlier than most. I retired because in my last 3 years I tried 6 investment fraud cases in which the average plaintiff had been retired for less than 2 years at the time of recruitment. The pattern was not random. The pattern was so consistent that I could no longer stay on the bench and pretend the timing was a coincidence. The schemes are engineered to target people in a specific window, and the window opens on the day you stop working. I want to tell you why the 18-month window matters, because once you understand why the targeting is timed to that window, you will understand why the protections you think you have are not the protections you actually have. In the United States, the moment of retirement is the moment when several things happen simultaneously to most people, and those things, in combination, produce the largest single concentration of vulnerability that exists in the financial life of an ordinary American. First, the retirement plan, which has typically been distributed across multiple accounts during the working years, often gets consolidated. The 401k from the longest job, the pension from the previous employer, the IRA, the smaller workplace accounts. The retiree, on the advice of a financial advisor, or simply for the sake of administrative simplicity, frequently moves these into a single rollover account. For the first time in their working life, the entire savings sits in one place. The retiree can now see the full number on a single statement. So can anyone else who learns of the consolidation. Second, the retiree has just stopped receiving a steady paycheck. The psychological adjustment to living on accumulated savings rather than ongoing income is one of the most difficult financial transitions in human life. The retiree begins thinking, often for the first time, about whether the savings are sufficient, about inflation, about how to make the money last another 25 or 30 years, about whether the returns from a standard portfolio are going to keep up with the rising cost of medical care, of housing, of helping the grandchildren. The retiree is, almost universally, anxious. Third, the retiree has more time than he has had in 40 years. He answers his phone, he reads his mail, he attends events at his church or community center that he previously skipped. He goes to the coffee shop in the morning and stays for an hour. He is, in short, available in ways that he was not available the year before. The combination of these 3 conditions, consolidated savings, financial anxiety, and unstructured time, is what the schemes are engineered to find. The fund managers who run these operations understand the demographic with the precision of actuaries, because their business depends on understanding it. They know exactly what the recently retired person looks like. They know what he reads. They know which luncheons he attends. They know which churches he belongs to. They know how to be in the room when the question of where to place his money first comes up in conversation. I want to tell you how the list is built. Public retirement in this country generates a substantial paper trail. State employees, county workers, federal civil servants, public school teachers, university professors, military personnel. All of these retirements are reported in public records that are searchable by anyone with internet access and patience. Local newspapers, in towns under 50,000 people, regularly report retirements as part of their community coverage. Companies, particularly mid-sized regional ones, send retirement announcements to industry publications. The local Chamber of Commerce hosts retirement parties for prominent business owners. Beyond the explicit announcements, the recently retired person produces a series of signals that are easy to identify even when no announcement has been made. He changes his profile on professional networking sites. He begins making different purchases on his credit cards. He travels, often for the first time, in a way that produces visible patterns in his financial activity. He may downsize his home, which generates a public record. He may relocate. He may begin using his retirement plan provider's customer service line, which generates internal data that, in some cases, has been improperly accessed and sold. I want to explain how the data infrastructure works, because most retirees do not understand the scale of what is being aggregated about them. When you retire, dozens of institutions you have never directly interacted with begin updating their records about you. Your former employer reports your separation. Your retirement plan provider issues new tax forms. Your health insurance changes status. Your mortgage company, your credit card companies, your utility providers all begin to see slightly different patterns in your financial activity. Public records reflect changes in your address, your homestead status, and any property you may have transferred or downsized. These data points are not secret. The vast majority of them are publicly available or are made available by the institutions themselves through commercial data sharing agreements. Aggregator firms collect the data, organize it into demographic profiles, and sell access to those profiles to companies that purchase marketing data. The aggregators have no way of knowing whether the buyer is a legitimate financial advisor, a charity, a political organization, or a fraud operation. The same demographic profile is sold to all of them. The price is the same. The scheme operators do not have to find these signals manually. There are firms in the United States that aggregate this kind of demographic information and sell it to marketers. The vast majority of those firms are operating legally and serving legitimate clients. A small minority of their clients are not legitimate. The data is the same. The buyer is what differs. By the time you have been retired for 90 days, you are on at least 3 lists you do not know about. The lists are not labeled. The data on the lists is descriptive, not invasive. Your name, your approximate age, your former employer, your approximate retirement date, your zip code. The lists are then used by sales operations of various kinds, most of them legitimate, some of them not. What I want to convey is that the visit you receive, the phone call you receive, the introduction at the church coffee, the coincidence at the Chamber of Commerce mixer is not a coincidence. The recruiter, who is himself a victim, was given a list of names and approached the people on the list in roughly the order they appeared. He met you because you were on a list. He has no idea you were on a list. He believes he met you because of his own social activity. The fund manager who provided him with the names did not tell him how the names were obtained. Let me describe what happens in the 18-month window. In the first 6 months after retirement, most retirees are insulated by inertia. They have not yet completed the rollover. They have not yet started attending the new social events. They are, behaviorally, still operating like working people who happen not to be at work. The schemes know this. The schemes wait. Between months 6 and 12, the rollover typically completes. The retiree begins to feel the weight of having a single large balance. He begins to discuss it with his spouse. He begins often to mention it casually in conversation with friends. He attends a financial planning seminar, sometimes hosted at a local restaurant, where the host is an unaffiliated advisor who will follow up. The follow-ups begin. Between months 12 and 18, the retiree has typically had at least one investment opportunity introduced to him by someone he knows. If he is in a community where a Ponzi scheme is currently active, the introduction comes from a friend who has been receiving real distributions for some time. The retiree, who has now been thinking for 6 months about whether his savings are sufficient, hears about an investment that has been paying 9 to 14% annually to a friend he respects. He listens. He asks questions. He attends the luncheon. I will describe a composite case that illustrates how the 18-month window operates in practice. There was a man, in one of the cases I tried in my last year, who had retired at the age of 64 after 32 years as a regional manager for a Midwestern manufacturing company. His pension was modest. His 401k, after consolidation, was substantial. His total retirement assets were approximately $420,000. He was retired in February. By April, his employer had reported his separation through the standard channels. By May, his pension provider had updated his beneficiary records, which, in his state, became part of a quasi-public registry. By July, his name had appeared on a list compiled by an aggregator firm in another state. By August, the list had been sold to 7 different commercial buyers. One of those buyers was a marketing operation working on behalf of a Ponzi scheme that had been collecting names for approximately 3 years. In September, an acquaintance from the man's former Rotary Club, who had been an investor in the scheme for 2 years, mentioned the investment over coffee. The man asked questions. The acquaintance offered to introduce him to the fund manager. The introduction occurred in November. The man invested $20,000 in December as a test. He invested an additional $200,000 the following March. He invested the remainder of his savings the following August. The total time from his retirement date to the moment his entire portfolio was inside the scheme was 18 months and 3 days. The fund collapsed in May of the following year. He recovered $3,400 after a 4-year legal process. He returned to part-time work at the age of 67. He still works, as of the date I am recording this. The 18-month window is not magic. It is the duration of the conversation, on average, that the schemes are engineered to occupy from the moment of retirement to the moment of first investment. Before 18 months, the retiree is not yet ready. After 18 months, the retiree has typically committed to whatever path he is going to commit to. The schemes have learned to operate within that window, because the window is when their conversion rate is highest. If you are listening to this in the first 18 months of your retirement, the conversation has either already begun or is about to begin. The friend who is going to introduce you to the investment may or may not have spoken to you yet about it. He may already have invested. He may already have begun receiving distributions. If you have noticed in the last 6 months that a friend or acquaintance has been doing slightly better financially than you would have expected and has mentioned an investment in passing, that conversation is the conversation. I want to ask you to subscribe to this channel and leave a comment if any part of what I am describing is recognizable from your own life or from someone you love. The comments are how this video reaches the next person who is in their first 18 months and has not yet been approached. The pattern depends on its targets being unaware. The only countermeasure is that the targets know what is coming before it arrives. I want to give you a description of what protective behavior looks like in the 18-month window. This is not theoretical. This is the behavior I observed in the very small number of cases I reviewed, often as a request from outside my docket, in which retirees had successfully avoided being recruited by schemes that subsequently collapsed. The retirees who avoided the schemes were not smarter than the retirees who were caught. They were not better educated. They did not have more financial experience. What they had, in nearly every case, was a single procedural rule that they had committed to in advance of any specific opportunity arising. The rule was that any investment, regardless of source, regardless of recommendation, regardless of how convincing the documents appeared, would be evaluated only after the manager's regulatory registration had been verified through the public databases maintained by the Securities and Exchange Commission. The rule sounds simple. The rule is, in practice, the most effective single protective measure available to a recently retired American. The reason it works is that legitimate registered investment advisors in this country are required to maintain accurate public records of their registration, their disciplinary history, and the registrations of any funds they manage. The fraudulent operations, by contrast, are either unregistered or registered in a misleading way that becomes apparent on examination. The verification process takes approximately 10 minutes. It can be done from any computer. It does not require any expertise. The retiree types the manager's name into the public search tool, reads what comes back, and decides whether the registration matches what they have been told. If it does not match, the answer is final. The investment is not legitimate. I want to make this concrete. The retirees in my courtroom, in nearly every case, had been told the fund was registered. Some of them had been shown documents that referenced registration numbers. None of them, before investing, had checked whether the registration numbers were real. The verification, had they performed it, would have taken less time than the meeting at which the investment was first introduced. None of them performed it. None of them. Across 200+ cases. I do not know how to convey to you, more clearly than I am attempting to convey it now, that the single act of typing the name into the search tool is the difference between a recoverable retirement and an unrecoverable one. I have read the case files. I have presided over the trials. I have heard the testimony of the plaintiffs. I have entered the judgments that did not return the money. The verification was always available. The verification was never performed. I want to be specific about how the verification process actually works, because most retirees who hear about it do not perform it correctly. The Securities and Exchange Commission maintains a public search tool called the Investment Advisor Public Disclosure Database, often referenced as IAPD. The Financial Industry Regulatory Authority maintains a parallel tool called BrokerCheck. Both tools allow you to enter the name of an individual or a firm and to retrieve a complete record of their registration, their disciplinary history, and any complaints filed against them. The tools are free. They are accessible from any computer. They are searchable in approximately 60 seconds. When you perform the verification, you are looking for 3 specific things. First, the registration must exist at all. If the search returns no results, the manager is not registered. the conversation is over. Second, the registration must match the role the manager is claiming. A registered broker is not the same as a registered investment advisor, and a registered investment advisor is not necessarily registered to manage the kind of fund the manager is describing. Third, the disciplinary history must be clean, or if there are entries, they must be old, minor, and resolved. Recent or substantial disciplinary entries are warnings. If you do not understand the registration record you retrieve, you can call your state's securities regulator, who will explain it to you for free. Every state in the United States has one. They answer phone calls. They are happy to help retirees verify managers because their job is to protect retirees. The phone call takes approximately 15 minutes. I want to add 3 observations. First, if a recommendation comes to you in the next 18 months from a friend, a relative, or an acquaintance, do not allow the source of the recommendation to influence your verification process. The relationship is not corroboration. The verification is not an insult to the friend. The friend, if he is a legitimate friend, will understand. The friend, if he is unwittingly part of a scheme, will be unable to object meaningfully because the verification process is not directed at him. Second, if you encounter resistance from a recommended manager when you ask to verify his registration, the resistance is the answer. Legitimate managers expect to be verified. They are required by law to facilitate verification. If a manager pushes back on your verification, however politely, you have completed your due diligence. The investment is not legitimate. End the conversation. Third, the retirees who lost their savings in my courtroom were, in every single case, intelligent people who were operating within their normal pattern of judgment. Their normal pattern of judgment had served them well throughout their working lives and was not designed to detect the specific class of threat they encountered in retirement. The threat is engineered by people who have studied your demographic for a living to be invisible to your normal judgment. The only effective response is to add a single procedural step that does not depend on judgment at all. The verification step. Make it a rule. Apply it without exception. I retired earlier than most judges. I retired because I could not look at one more docket of plaintiffs in the same demographic, with the same total losses, with the same petition language, and continue to do the work that produced the same outcome. The work I did from the bench could not return their money. The work I am doing now can, in some small percentage of cases, prevent the money from being taken in the first place. I am operating on the theory that the small percentage matters. If you are watching this and you are within your 18-month window, I am asking you to apply the verification rule before you accept any opportunity, no matter how reasonable it sounds. If you have a friend or a family member in this window, please send this to them today. The window is not theoretical. The conversation that is going to cost them their retirement is, statistically, occurring this month or next. The only countermeasure is information delivered in time. Thank you for watching. Please share.